Good morning, ladies and gentlemen, and welcome to another episode of The Long and the Short of It by Clive Lambert, Darren Sinden, with a little help from me, Mikhail Onachov. The significance of today's episode is that it's the last webinar of this year. We'll go on a short break and we'll return in 2015 with plenty of new and exciting material to cover. Before we go any further with this particular webinar, please remember that trading FX and CFDs using leverage may result in the loss of all your deposit. Trading losses can exceed all of your deposits, but in Admiral Markets UK, we do have negative balance protection in place. My name is Mikhail Onachov. Here's my lovely picture. And if you're looking to invest as a present to yourself more than £1,000 over the next few weeks before the end of the year, please contact me in person for a nice 10% extra. Whilst you do that, please tell us what topics would you like us to cover in the next year. You can always let us know what is your opinion on webinars, what things can be improved, if any. If you would like to get in touch, please do so by emailing me at mo@admiralmarkets.com, and I will gladly have a lovely conversation with you. With that said, I will now pass the microphone to Mr. Darren Sinden, who will start our last webinar session of this year. Darren?
Thank you, Misha. Welcome everybody to the final episode of The Long and the Short of It for 2014. But as Misha says, we will definitely be back in 2015, and as he says as well, with some new exciting content. But please do give us your feedback. We'd love to hear it. So, as ever, and I think since we started these webinars, we've been in a period where things have changed very quickly, and a lot has happened in relatively short spaces of time. October seems a long time ago. So much water's gone under the bridge, but today's the day that perhaps we can perhaps put that to one side for the moment and consider what's going to happen in 2015, what's going to happen going forward in the new year, and that's what we're going to look at today. So without further ado, I shall press on. And we'll start, as we always do. Regular viewers will be aware that we try and just spend a few minutes talking about the current tone trend of the market, what's informing our thinking, what we think maybe you should be thinking about, what sort of news items have caught our eye and may give us pause for thought today and in the days to come. So our first slide, as ever, is mood of the markets, and the mood of the market today, I think for the most part, is happy, stroke relieved. I've put there happy because what they heard last night really from Janet Yellen and her colleagues at the Federal Open Markets Committee. She basically she tried to please everybody, I think, is the honest answer. There was something for everybody in her speech. She left the door open potentially to an earlier rate rise than we had perhaps anticipated it from the US, but she also said that she was mindful of the fact that the economic environment was still fragile, and there were reasons to think that that lower rates could persist. Net anyway, that sort of degree of flexibility was seen as being positive. We've also heard some positive sound bites, which we'll come to a bit later on, from Moscow this morning. But last night the States took it upon itself to rally quite strongly, and as you can see here from the table on the right, US equities strongly better. The S&P up 2%, for instance, back through 2000 quite nicely. The S&P mid cap also rallying 2.3%, and the small cap end of the scale doing very well there, 2.7% for the S&P's small cap index. The Russell 2000, the more widely traded small cap index, up 3.1%. Against that, we saw a contraction in volatility. So the VIX, which had been rallying sharply, if you remember, this is the measure of the volatility, or the implied volatility of the options of the constituents of the S&P 500 index, and it's often referred to as the fear index. That's been spiking sharply recently, but yesterday, with those soothing words from the FOMC, that came back by 17.5% and is back below 20. Whether it will stay there, of course, is debatable. There's lots of potential for a few bumps on the road to Christmas, but volatility is certainly dampening down for the moment. Okay, well, we said that there was some interesting sound bites coming out of Russia. Vladimir Putin's been giving his annual press conference this morning. I think that's still ongoing. But the bits that have caught my eye, just a few snippets here. Do we want our Russian bear to become a stuffed animal? Quite an interesting question, really. I think what he's saying there is that Russia was in danger of becoming just that, a trophy, if you will, on the wall of the markets. Obviously, the ruble has collapsed. They've been forced into extraordinary measures to try and stabilise the currency. It seems to be working, but obviously, selling their foreign currency reserves to support the ruble, is a game they can play for only so long, because obviously they've got a limited amount of foreign currency under their belt. But the markets were heartened to hear the next line, that the Ukraine crisis should be resolved without the use of armed forces. I think everybody would prefer it if there could be a diplomatic solution, and sooner rather than later. Of course, it's easy to say that, but let's look for perhaps the Russians to reach out and resume meaningful talks. But Mr. Putin's, he's happy to be fighting, but in this time fighting inflation rather than the Ukrainians, and he says that fighting inflation is mainly a task for the Central Bank of Russia, but also for government, and that government must monitor fuel and food prices every day and every week going forward. Fuel prices presumably won't be rising too dramatically in Russia, particularly if the prices for oil based fuels, because obviously they're subject to the same downward pressure as they are for anybody else. But anything obviously that's imported into Russia is now going to cost considerably more, probably nearly 50% as much as it did at the start of last week. GDP growth in Russia, he said, over the last 10 months was between 0.6 and 0.7%. I think, unfortunately for them, that the weakness in the price of oil is basically going to eradicate that and more. So I think we touched on this before, but I think a recession is very likely for Russia going forward, and an inflationary recession could be the end game there as well. So they're far from out of the woods, but coming to the table about the Ukraine might help stem the rot, as it were. Okay, so the third slide that we always look at in this section is what the money thinks, and we often refer to the Bank of America Merrill Lynch fund managers survey that comes out on a monthly basis. You may recall several hundred fund managers are surveyed regularly by Merrill Lynch, and these fund managers manage between $500 and $550 billion of money is under their control. So what they think and what they say and what they do is market moving and does matter. So what do the fund managers think in December? Well, they like to be long Japan or long Europe and long technology, but they will prefer to be short energy and short Russia. We just talked about Russia, and obviously energy stocks go hand in hand with them. They're both affected dramatically by the weak oil price. A big period of adjustment for the energy sector, obviously, as they come to terms with a 50% fall in the prices of benchmark crude. And investment managers now hold a lower allocation in resource stocks than at any time in at least the last 12 years, according to the survey data. So the resource sector, including energy stocks, is coming under pressure, continuous pressure, and managers don't think that's going to change anytime soon, I think, is the message from that. They're more bearish on oil, natural gas, copper, iron ore, coal and the like than they were in the depths of the 2008 to 2009 financial collapse. And Merrill Lynch has termed that as capitulation. That's a word you'll hear from time to time in financial markets, and what it basically means is everyone's given up the ghost. That's often a point, actually, when contrarian managers will come in and start buying a sector or an instrument when the market, when everybody else in the market is perceived to be giving up. I think it was Nathan Meyer Rothschild said, "I always buy when the cannon roars," and he've also had comments like, "Be greedy when others are fearful." So buying at the bottom, if you're a brave person and you've got deep pockets, might be a strategy. I think the trick there is, of course, to identify the bottom, wait till the market tells you it's the bottom, rather than trying to pick it for yourself. Well, money managers are not completely bearish. What they do like are European stocks. That's based on the prospects of quantitative easing in the Eurozone. I think we talked about that going forward, and we'll discuss it again probably in a few slides' time. They also are, and I'll paraphrase this, deeply in love with Japanese stocks, and that was obviously helped by the re-election of reflationary Prime Minister Shinzo Abe. A lot of expectation around Mr. Abe. We've seen dollar yen pull back. Struggling to get back above 118.70. So the move back above 120. We'll have to wait for a moment. But equity markets were a bit better again in Asia, and we may see the yen weaken further over the coming days, or certainly into the new year. I'm sure the Bank of Japan would like to set that train rolling again. So, having covered all that, what can we perhaps expect in 2015? Once again, we're a little bit constrained for time, so we'll just look at a few of what we see as the key issues, the key possibilities for investors in 2015. But again, these are fluid situations, things can change, and it might be that we revisit some of these stories early in the new year. So dollar strength, well, we've touched on this. I think it's unavoidable really as far as foreign exchange is concerned. Dollar strength has been the key theme really for many analysts into the closing stages of 2014. They would expect the dollar to strengthen and to continue to strengthen in 2015 against both developed and developing currencies. As we've said before, long the dollar, short euro is amongst the most popular, if you like, crowded trades on that basis. Plenty of money is stacked up that way. And last night's FOMC meeting liked to strengthen that view. I think, as I said, the key takeaway here was for those that bullish the dollar. Janet Yellen left the door open for an early rate rise, which could come, as early as Q2 2015, and that's been interpreted as meaning April. Whether we see that, I think, is open to question. It will be determined by the economic data and probably by other global events. Nonetheless, the market's happy to believe that that's the case, and so I think we can see, I think we will see that 120 level tested in euro dollar in the near future. It may not be this side of Christmas, but perhaps the early part of the new year. Higher US interest rates, which is what the market's thinking now, as we just discussed. Well, that would see money flow back into the dollar, more money flow back into the dollar, I should say, particularly at times when risk is off the table, and the dollar does enjoy, the role of reserve currency. It also enjoys a role of one of two or three safe haven currencies. The Swiss franc and cable perhaps would join it in that, or sterling I should say, would join the dollar in that safe haven status. So if money is going to flow back into the US dollar, who will be the likely losers? Well, it's the emerging markets, unfortunately, that are most at risk, especially those that are commodity linked. The table on the right shows the performance of a selection of currencies against the US dollar over the year to date, in fact, and the South African rand and the Brazilian real have both performed poorly. Obviously, those two very, very commodity-driven countries, and I suspect that the stronger dollar will continue to weigh on them. As we know, a strong dollar means weaker commodity prices, and most of the time, and of course that's not good news for either Brazil or South Africa. But what about some other potential casualties of dollar strength? Well, the Mexican peso, perhaps. All right, yes, that's already been weakened against the dollar by, I think I'm right saying, 11% over the year to date. But could we see something? Some further, 11.7% actually, sorry. Could we see something further in terms of the slide of the Mexican peso? And what about its Filipino namesake? Now that's performed very well against the dollar, really held its own, down just 0.7% on the year to date. Philippines has been one of the best performing economies over the last couple of years, one of those sort of, if you like, tiger go-getting emerging markets. But unfortunately, if we do see the mood swing against emerging markets, that's just the kind of place where money's likely to come out of very quickly. If you had your money there for a few years, you doubtless made a healthy profit, and if it starts to look a bit shaky, then that money can easily be repatriated and turned into dollars. And when money leaves these emerging markets these days, it tends to do so very quickly and all at once. So I'll be watching that quite closely, I think, as we go into 2015 and the first quarter of 2015. So to try and sort of encapsulate that into perhaps one chart, I've drawn a chart here of the MSCI Emerging Markets Index. That's the ticker MXEF. This is an index that tracks the performance of a basket of emerging market countries across a wide variety of sectors and industries. Plenty of China exposure, a bit of India, Taiwan, South Korea, those kind of countries, as well as the other BRIC economies. Big holdings in finance, in banking, in technology, to a lesser extent in commodity-related stocks. But I've also then taken that index and plotted it against the US dollar index, and that's the trade-weighted basket, or the dollar versus its largest trading peers in a basket. You'll often hear people talking about, particularly US commentators, talking about the strength of the dollar index, and they see that as a good proxy for dollar trade as a whole, and rightly so. So this chart shows us how the equity index, the MXEF, has performed against the dollar index over recent times, and as you can see, we're testing back to an area of key support. This, by the way, sorry, I should say that what we've done here is divide the MSCI index by the dollar index to create a ratio. But as you can see, we're testing back to an area of key support. A lower number is bad for emerging markets, so the lower this ratio goes, the worse it is for emerging markets. A sustained breach of these key supports could see us back to levels that last seen in 2009, so support in here, and obviously here the 2009 lows where we formed a bottom. Below that level, basically, I think what we'll be seeing is money leaving emerging markets, so dollar strength and emerging market equity weakness will put us into this area here, so we'll be looking at this chart closely again in the early parts of 2015, looking for those clues that capital flight is about to take place. So let's press on. Europe and the euro, obviously close to many of our hearts. We obviously, those of us that are in this part of the world are living in the shadow of the European Union. What happens in Europe is obviously of great consequence to people in the Eurozone, out of the Eurozone, such as those of us in the UK, and from farther afield. A weaker euro, as I've said, is before, is probably most people's banker trade, if you will, for 2015. Premised on the idea of ECB QE, quantitative easing. We may hear more about that in the not too distant future as well. But if we don't get QE early in 2015, then there could well be some discord within the EU. As I said before, growth is patchy at best, particularly in the principal economies, and inflation is still an issue. Weak oil, which we'll touch on in a little while, won't do anything to improve the inflation outlook. In other circumstances that might be beneficial. It remains to be seen if it will be completely for the EU. Well, we've also got Greece to consider. It's a factor, something of a wild card, and as you're probably aware, the Greek presidential election is ongoing. They're hoping to try and find a candidate that various factions can agree on. If they don't resolve the issue over the presidency by the 29th of December, then under the Greek constitution there's a mandatory general election. If we had that general election, the polls seem to suggest that the hard left anti-EU, anti-bailout parties would be in government thereafter. That would obviously be something of a headache for the euro, and would, I would suggest, add further downward pressure onto the single currency. There's also the not insignificant fact that Greece has at least 15 billion euros of debt maturing in 2015, as we can see from the table on the right-hand side. Ironically, Greece has been the strongest performing economy within the Eurozone this year. So nothing's ever straightforward, is it? Within the EU, very strong economic performance, all those austerity measures that were taken back in 2012 and the bailout money would appear to have been put to good use. Finally bouncing back, and just as Greece appears to be getting its house in order, the political situation rears its head again. That's something that we must watch, not just in 2015, but obviously in the run-up to that 29th of December deadline. So a weaker euro, well, as I say, that's pretty much everyone's banker trade. It's hard to see past that. There is a possibility, of course, just before we discuss a weaker euro, that Mr. Trichet may be proven right that the two TLTROs, the targeted long-term refinancing operations that he's had in 2014, and his asset-backed security buying and covered bond buying in preference to full-blown QE may be proven to have done the job, and we'll need to be watching bank lending figures as and when they're released in the early parts of 2015 to have clues for that. The ECB will be doing just that. They presumably will have the data a bit sooner than we will, but we do keep an eye on that. However, assuming that that's not the case, the weaker euro then is seen as positive for European equities by many investment banks, and they're tipped to outperform their US peers in 2015, and those equities that are tipped to do particularly well are the ones with large overseas markets, ones that earn and sell their products and earn money from abroad, not just in the domestic European theatre. That may be tempered slightly though by the price of oil, and I think everyone's having to come to terms with what lower oil will mean for their economy, from a top-down and a bottom-up basis. And an example of where perhaps lower oil prices could dent next year's budgets, next year's sales forecasts for many companies would be the fact that Russians probably won't be buying so many German cars in 2015. The ruble's worth considerably less than it was only a few weeks ago. That BMW or Mercedes that perhaps you could have afforded when the ruble was down at 45 to the dollar, maybe now with when the ruble's touched 80, but back in the mid-60s is probably 50% dearer than it was in dollar terms to you. So perhaps you're not going to spend that money this year if you're a Muscovite looking for a new car. Maybe you'll make do with the old one. But net, a low oil price is seen as being positive for Europe, and it could help stimulate growth. Obviously, falling input costs, and hopefully some kind of reduction in household fuel bills as well, maybe leaving European consumers with a bit more money to spend. There are some problems with that line of thought though, because there are structural issues in the French and German energy markets. In the case of France, around 70% of their power is generated through nuclear energy, which is obviously not a beneficiary of a weaker oil price. I think we mentioned that before. German energy markets, very heavily regulated, very heavily subsidised in favour of green energy. And again, I think it's questionable whether a weak oil price will feed into lower energy prices in Germany very quickly. One could say the same for Denmark, which is heavily reliant on wind-generated energy, and again, that's obviously not a beneficiary of a lower oil price in itself. It's also interesting to look at the chart here, which plots euro-dollar against Brent crude in the period since April 2014, and they've clearly been trending in the same direction, and I've no doubt that will continue to carry on. Whether there's clearly a correlation, whether there's a causation between those two, I'm not so sure, but I think it does serve to show the trends between assets and how correlations can work. And as I say, I think that trend is going to continue. I know Clive's got slightly less bearish on his oil targets for the moment. I know that he'll have something to say about that in his half of the webinar. But again, that's certainly a chart that I'll be watching. Great, good stuff, Clive. That's a chart that I'll be watching as we go into the new year as well. So, what else can we look forward to? Well, a test perhaps again of that Euro Swiss franc peg, that 120 level. interesting news from the Bank of the Swiss National Bank, the Central Bank of Switzerland this morning, as it formally introduced negative interest rates to defend the franc. And I wonder here myself if this is a bit of preemption on behalf of the Swiss National Bank. Perhaps, as I do, they have concerns about the strength and the strength of emerging markets and the likelihood of capital flight from the emerging markets to safe havens at some point over 2015. You remember 2014 started with just that scenario, and of course the Swiss are desperate to see, to stop the franc appreciating and to try and deter people from investing into Swiss francs. So from the 22nd, the Swiss National Bank will charge commercial banks 0.25% interest on money that they deposit at the central bank. So if you want to park money in a Swiss bank account, you're going to have to pay for the privilege. Quite a bizarre scenario, almost sort of Alice through the looking glass scenario. As I say, the Swiss franc is one of those 3 safe haven currencies, so that may not deter buyers if we have issues in emerging markets and in Greece perhaps. But we've been here before. The chart on the right hand side is a plot of Euro Swissy against 2-year bond yields in Switzerland, and if we look back to 2011 and 2012, we can see that the franc moved below that 120 level. Obviously the peg hadn't been instigated then, but that was the kind of area that the Swiss National Bank didn't want to see it in, because of the the export-led nature of the Swiss economy. It's very keen to prevent that happening again, hence the peg. But here's in July 2012, we can see that 2-year bond yields in Switzerland dipped dramatically below zero, a negative 0.4% yield before they rallied again. So we've been here before. With negative interest rates in Switzerland, now actually officially introduced for the first time, but I'm not so sure, as I say, that won't keep speculators from having a tilt at that 120 level, and or even if people aren't speculating it, a flight to quality, if you will, flight to safety, if we have problems again in both potentially the emerging markets and the Eurozone. So what about good old Blighty, the UK and the pound? Well, the thing here is that potentially political uncertainty could overshadow our improving economy. The UK continues to improve, the economy is picking up. Good employment data again this week providing a boost. Mark Carney, Governor of the Bank of England, went on the record to say that he believed the low oil price will quickly benefit the UK economy, and that it was a net positive for the UK. He must have concerns though about inflation still, as lots of people will. UK inflation fell to 1%, so roughly, exactly 50% of the or half of the Bank of England's 2% inflation target. The concern for cable is that is in the run-up to the general election in May, as the coalition government here comes to the end of its term, that we would see a stronger showing from the disruptive parties, if you will. The SNP, the Scottish National Party in Scotland, who of course narrowly lost the vote to take Scotland independent in September, but are now looking to achieve much the same ends through a process of increased devolution, and UKIP as well. As we said, they won 2 out of the 3 seats they contested in recent by-elections here in the UK. They will stand on an anti-EU, anti-Europe ticket, and if nothing else, they might force the hand of the leaders of the major parties, and I'm thinking here really of the Tories and the Conservatives, to stand on a similar ticket to avoid an upset. The worst case scenario probably for cable would be a hung parliament, or a parliament with a very small majority for one of the main parties, in which the role of UKIP or the SNP could be amplified, and I think that might upset the apple cart as far as the strength of the currency is concerned, at least in the short term. And we saw that political risk can definitely influence the value of the pound sterling. Here's cable, the British pound against the US dollar, and the area I've highlighted here shows the sell-off in the run-up to the Scottish independence votes, and you can see the currency weaken sharply. And we, I think we talked about this before, but there are certainly targets out there for cable employed by some technical analysts down to 135, 136. So whether it gets there in a straight line, I don't know. But we'll see more as we enter the new year, and obviously all eyes then on the polls and the opinion polls, which will show voters' potential leanings. Some would contend that they should give a true reflection because people change their minds at the ballot box, but UKIP strength, SNP strength will probably see a wobble in sterling. And so finally, in my half of the show, we look at the prospects for inflation or deflation, and this is a table taken from that very useful economist.com node site. Marvelous table here that they kindly provide us that plots a ton of economic data on a wide variety of economies. Here I've selected the G20, so the 20 biggest global economies, and we're looking here at inflation rates. Well, in the developed world, Italy, France, Germany, look, 0.2, in the 0.3, 0.6 readings from November. Slightly better sorry about that, slightly better for some of our developing markets. At least they've got some inflation here in China. But if we look down here at the developing world proper, high inflation. Argentina is obviously something of a special case. The data's not there for that one, but for Turkey, inflation running at 9%. That may cool slightly because of weaker oil. Turkey's a net importer of oil, and so that could probably, a significant net importer of oil, so that could probably help them. As we flagged as well, Indian inflation may be helped by a weaker oil price, but obviously Russia inflation likely to continue to rise with that weak euro. Japan, of course, would love to see some inflation, but ironically, a weaker oil price for Japan, again, a massive importer of energy products, may actually dent the government's efforts to create inflation. So that's a column that we'll be keeping a close eye on. We'd like to see some of that emerging market inflation coming down. We'd like to ideally to see European and Japanese inflation rising, particularly in Japan where there is deflation proper already, but equally we don't really want the likes of Italy, France and Germany dropping off anymore either. So look, those are the thoughts I'm going to leave you with my half. Just really remains to say thank you for taking the time to listen to what I've got to say, I had to say over the past few weeks. Have a great break over the holidays if you're celebrating them, and we look forward to speaking to you in 2015, or I do indeed. And I will now pass over the microphone to Mr. Clive Lambert.
Thank you, my friend. Excellent as usual. And let's just see if I can try and do a similar job of talking people through some of my thoughts, which are obviously based purely on charts. Can I just do that? Sometimes we have a trouble here. Can you hear me? Am I coming through loud and clear?
Loud and clear, Clive.
No, marvellous. Okay, good stuff. Well, I am in a very, very good mood today, because today is the last day I'm working this year. And it's been typical of 2015. I'm busy as you like. I've got I did a couple of bits this morning, various people, and then I'm up in London to see some people later on. I'm squeezing this in the middle, and as I did things slightly different to Darren, and because obviously it's easier from a technical point of view to look back and look forward all at the same time. After all, technical analysis is about looking forward by looking backwards. You're looking at previous price history to give you a clue as to what may happen in the future, or not, not to tell you what's going to happen, but to give you some probabilities and to highlight some key areas and that kind of thing. So hopefully that's what I'm going to do. Did that with bonds, equities and commodities on Tuesday, and I think interestingly, I think Darren sort of touched on this. this oil story is huge now. Everybody's talking about oil now, and it's no coincidence to me that around the same time as everybody starts talking about it, suddenly we're actually finding it seems to be finding its feet, and yeah, that's no big surprise. And I'm really pleased that actually around that sort of time as well, it hit some targets that we've been looking for a few months. So I'm more than happy to sort of stand aside, if you like, a little bit in oil now, cover some shorts, and just see what happens to that into the year end and revisit it again in 2015. But right, today topic is Forex markets. A lot of the stuff we've covered in previous webinars and a lot of the analysis I do day by day really focuses on the shorter term charts. For the analysis that we produce for clients, we're looking at 30-minute, 60-minute, daily, up to weekly charts, basically. To do the sort of thing that that we're looking to do for this sort of for this purpose, i.e., I look back at the year and I look forward to next year, you just pretty much apply the same principles and same sort of things, but look at longer term charts. And so the first chart we've got today, it's a daily chart, and it shows the year for the what's known as the dollar index. So this is the US dollar against a basket of currencies to try and give a fair reflection of where the actual US dollar is. Back in May, that was trading at 79, and have been crabbing along the bottom there, as you can see, for a good part of the early part of the year. And then from July onwards, we started to see a significant rally in that in the US dollar, and that has, I mean, it's kept going. Really, we've seen a bit of a pullback in the last 2 or 3 weeks, but nothing too spectacular. And you can see I've got a couple of trend support lines on that chart that suggest to us, from a chart point of view, that it can keep going. Basically, that is the trend. And the old NAF catchphrase is the trend is your friend. So I'm not going to battle against this one right now, and I think it's the theme to be going with at the moment, is that the US dollar can continue to strengthen, and that. Right, so we've got some support on that particular chart around 87.60 from the steeper trend line, and 85.80 from the less steep trend line, and they're the sort of lines in the sand, if you like, that I'll be using as a reference to maintain a bullish stance on that particular index, if you like. But, and here's the but, if you then go to a bigger time frame, the weekly chart, we can see that we are actually approaching around this 90 area for that particular index. Big resistance. Okay, not only was it a failure back here in 2008, 2009, 2010, we seem to be, we've got there and started to struggle a little bit again this year. It's also, and I think we talked about Fibonacci in one of the webinars, if we take the move from that 2002 high down to the 2008 low, 90 is the 38.2% retrace. It's where the market has taken back 38% of that move. And if anybody wanted a chart to illustrate how well, how good Fibonacci can be, and how why it's so well watched and referenced by people like myself, there it is. Because sold off from here to here, got back 38%, and then fell over and gave it all back, and continued to struggle below 90 for that index. So what that chart says is short-term trend, and this is the whole thing. You've got to look at different time frames. If we look at there's our daily chart, you look at that, you go, that is an uptrend. There's nothing to worry about there. And then we go to the next time frame of the weekly chart, and there goes our big, capital letters. But hang on a minute. Okay, now if the short-term trend wins the day and we get through 90, then our Fibonacci lines, if you like, they suggest to us that 96 and 102 are the next resistance levels, and if we can get to 102 up here, that's the 61.8% retrace of that entire move. So that allows us to, to to frame things, to realise the bigger picture, and to be able to make our trading decisions and base our calls around those type of things. So 90, big area, dollar index. So that same move, if you translate it into the euro against the US dollar, has been, since the middle of 2014, has been a sell-off from 140 down to 122, which has found some support in the last. It's calmed down. You can see on this chart that the big period for that particular for that move was this sort of July through to the end of September, where we saw a big chunk of that move actually happening. Then things steadied out. We have made new lows since. That's a bullish engulfing pattern on that weekly chart last week. Although it has to be said, I put these slides together on Monday, and since then we've given most of this back. We're right down here now, obviously with some weakness seen yesterday on that particular pair on the Federal Reserve announcement. Okay, so the pullbacks have been shallow on that particular cross pair. What do you call it? Okay, and here we go with another. Today seems to be full of big buts. Here's another big butt, and I cannot lie. It tells us that. Sorry about that. It tells us that 121 for euro US dollar. And this is a weekly chart now, and we're going all the way back to pre-euro days. Actually, this last part of the chart here is is actually a sort of theoretical euro based on the Deutschmark. Is how my charting system deals with it. The euro came into existence around here. This was the dim Vim era, and then off we went. Right, so. This is these gentle trend lines can sometimes be really, really good. And that is getting close again, and that's around 120. As well as that, we have the 50% line there, that's at 121. As well as that, we've got a support of 120.5 there, and 118.76 there. So this may be coming off and may have seen a big sell-off over the course of the second half of this year, but actually what it's doing is just coming back to a major support area, an area where it has been bought before. So that is one of the big things to be aware of. If we were to break that 119 to 121 area, then we could probably very quickly go to 112, 113 is what that chart suggests, but for now we're holding above it and finding some buyers above that area. Another major theme, big story in the second half of this year has been the weakness of the yen again, with Shinzo Abe doing his bit to try and kickstart an economy that's been flat for 25 years by weakening the currency, and that shows up nicely on our charts. And using a few of the methodologies that we've talked about in the webinars, we can see that we have, what happened throughout. The first part of 2014 is this bit here, okay, and we just went sideways to lower in a very, very tight range, and then things suddenly went boom, off we go again. And do you remember we were talking about these continuation patterns last week? I think it was last week, and we said, that if this is the first part of the move from here to here, and this is where the second part of the move starts, and this was a consolidation in the middle, then we have got, we can get an idea, we can get an indication of where that move may end on the basis, using an assumption, and that's all it is, that this is halfway through. And if we use that assumption, it does suggest that actually there's higher targets that can be achieved for dollar-yen still, i.e. we can see further weakness in the yen crosses. This is, remember, a bigger picture call. We're looking at a weekly chart going back for 2 or 3 years. The targets that it does suggest are 124.16, 125.60, with an extreme target at 130.60. Okay, we're not going to get there in a hurry, and actually what we saw last week was something, was a bearish dark cloud cover pattern on the weekly chart, and we have seen some weakness since then. That's currently currently trading 118.60, pretty much where it was on Monday when I put these charts together. So that's still sitting there looking like that, and I actually think in the very short term, and I've got to put a call out today for Euro yen actually to say that we could pull back to 144 before Christmas. I will be looking at that in the new year, maybe if we've held 117 even, or got down to 114 even for dollar yen, and are starting to see some buyers returning, then I'll be trying to get on that sort of move, because I do believe that the overall trend is still higher and there's still upside targets to be met, if you like. So that's dollar yen, looking at the weekly. What's my next slide? Let's have a look. Yeah, euro yen. Same sort of thing, really. In fact, arguably, this is interesting. We're at 146, 147 at the moment. And actually, if we're using that classic chart technical analysis methodology, we've got ourselves a falling wedge there over the late part 2013 and the first couple of quarters of this year. And you know what the measured move target on that baby is? That's saying if there to there is the first half of the move, this is a consolidation, and now we've broken higher here. It says we can go to 190, which is pretty significant. What that chart does say, if we go back though, we look back to 2007, 2008, is that 169 is a massive resistance. And I've done a little sort of Fibonacci projection thing here. I've actually I spotted that if you place, if we were to assume, and this is a bit of sort of reverse engineering, if you like, of the Fibonacci's, right? If and when we got back, if and when we got to 159 here, this is where the fib lines would line up. The 38.2 would be sitting on 134.19, which is that low, and the 61.8 would be sitting on 119, which is that sort of support resistance there. Yeah, that area there as well. So what I'm basically saying is that that would line up and look quite nice and symmetrical if we were to see a rally to 159 before we saw some sellers. And that's just a glimpse into some of the sort of harmonics work and some of the ways that we use Fibonacci to get projections for things that are, you know, a while away, or looking for upside levels and important areas on markets that are travelling to areas that haven't been seen for a while. I think I'm babbling a bit here. I'm sorry. I do apologise. Hopefully it makes some sense to you. It's just about making sense to me. It must have been. It's been a long year. You have to forgive me. So there's some upside targets. Short term again, yes, as I say, I think we can go back down to 144 in that. I put a little short out this morning, but I'm not looking for a massive, pullback. I think 143.50 to 144.00 is about as good as we could hope, maybe, on that. And you know, the thing about these yen crosses, both dollar yen and euro yen, is that they are a little bit at the vagaries of this whole risk on, risk off type of way of that people look at the market. I'm not a fan. I can't stand the phrase. I think it's one of the most overused, ridiculous phraseologies ever. That's been around in the markets for a long time, and I think that people get caught out with having these generalizations. When things decouple, which they always do. So you have to be careful not to get tied up with one mantra, because it can quite often, the wheels can come off just when you think it's what's the classic phrase that I can't stand? A no-brainer. It's one of my all-time favourite least phrases. I can't stand it. One of my analysts put it on one of the reports the other day. I took it off and I said, I'm not having that phrase on one of my reports. Please never use it again. Which is, I'm not often. I think I'm a reasonably good boss. I don't try and impose too much on my staff, but that was one I did on that occasion. I went, no, we're not using that. Right, okay. Let's crack on. I am rambling. Australian dollar's been a theme as well. This year it's been seeing some steady declines. The RBA governor, Glenn Stevens, is very, very happy about this. When it was up at 92, 93, 94, he was saying, oh, no, we should be at 85. Well, he's got his wish, and actually we're continuing to go lower. And there's some downside targets for that particular, for Aussie dollar against US dollar. And I think Dad's touched on this in his talk about the idea of weakness in these commodity, in some of these commodity related forex crosses. 79.5 to 80.5, big area of support for the Aussie dollar. So I would expect to see some buyers returning if we were to get down to that sort of area, but for now the short-term trend is lower for the Aussie dollar. Why 80? Well, right, okay. It's the 80.66 is that 2010 low. 79.50 is the 61.8% retracement of this entire move here. So yeah, 80 is an area of support, and we wouldn't be surprised to see buyers returning on gains to on weakness to that area. Okay, what else have we got? Let's see. Swiss franc. Haha, this is interesting. I talked about this. I put this together on Monday, and I said 120, and prepare for battle. Next year's big story: Swiss National Bank against the markets, or against the hedge funds, or against anybody who wants to put their head above the parapet and have a go at this 120 level. This is what currency intervention looks like on a chart. Okay, that blue line is where the Swiss National Bank said you're not going below here. And for a large period in 2012, the market just bumbled along right there on that blue line. And then we pulled away, 126, 125, 126. Looked like they'd done their job. We've basically since then, what's that? That's the first part of 2013. Oh, hello. Hello, something went funny there. Hopefully you still got me. We're back to this 120 area. We've come all the way back to it. I'm going to show you something. I'm going to show you something. Oh no, I'm going to show you that. I'm going to show you that. I'm going to show you this. Right? Doesn't show much on there, but let's go to a daily chart. Swiss National Bank came out today and went, well, we're going to do negative interest rates. I think Darren mentioned it. And look at that move today. Whack. 120.98 traded. That's on the daily chart, okay? I mean, if you look at it on a weekly, on a monthly, it doesn't really show up. You look at it on the weekly, shows up a bit more, and obviously that was the chart we previously looked at. Look at it on the daily, and well, if we now get to a 60-minute time frame, that's quite a move, isn't it? Hey? So that was the big story of today, and maybe they've bought themselves some breathing space with respect to what I was expecting may have been a sort of a battle, a bit of a battle between the Swiss National Bank and the markets. One of the most famous battles between a central bank and the markets, if you like, was Bank of England against George Soros. I remember it well. I was just starting my career in the city, and Mr. Soros won that particular battle. And obviously as well, Russian ruble, there's a bit of a, the same sort of things going on now with the Russians doing their best to defend their currency. That's Euro Swiss then. It's got a bit more interesting. Dollar Swiss has had a good 2014. And again, this is a very interesting chart. A couple of charts to sort of to get you thinking about putting things in context. Okay, there's a good looking rising market, isn't it? March, April, May, since then we've been steadily rising. Very nice. Put it in context. That's the weekly chart going back to 2000, and that's dollar Swiss. Ah, okay, suddenly it doesn't look so ludicrously soar away bullish, does it? We've got something actually that's just coming back to resistance. There's plenty of resistance, in fact, on that particular chart. An absolute swathe of resistance. Oh, it's a good word, isn't it? Swathe. A swathe of resistance sitting between where we are right now and 101 sort of 06, which is that falling downtrend line there. So we're going to get through a fair bit there if we're going to continue this rise. If we can get above 101, 102. We could very quickly go to 113.28, which is the 38.2 retrace of that entire drop. That's my slides done, I think. That's maybe what, as a quick disclaimer at the end, obviously I've given a few views there, and they are very much the views of Futures Techs, and we are authorised and regulated by the Financial Conduct Authority and are allowed to give our views, and so hopefully that is something for you to have all thought about. We've given you a few pointers, a few thoughts. It's been a pleasure doing these webinars for Admiral Markets, and it will be a continued pleasure because we will be back in 2015. And everybody have a very good festive break. All the best to my fellow panelists Darren and Mihail. Cheers guys, I'm done. Signing off. Cheers.
Thank you very much, Clive and Darren. Thank you, and have a great Christmas and New Year's as well. To all our participants, you will receive a special email notifications when we decide on the first webinar of next year, and hopefully we're going to see you all there. Thank you very much. Enjoy your festive period. Bye-bye. See you in 2015.